Hi candidate, welcome to another session of manifested online classes. So in this session, I want us to continue with the topic number 3, and I want us to look on one of the subtopic from that topic number 3, and the topic is to do with the presentation or preparation of financial statements by companies which provide insurance contracts to their customers. But even before we look on how those particular financial statements are prepared, we need first of all to define what is an insurance contract, basically the various types of insurance contract provided by the insurance companies, and then later on we are going to look on the final accounts which need to be prepared by companies providing insurance contract to their customers. So an insurance contract is a contract which is entered into between two parties, the insurance company, or basically the insurer, and another party who is called the insured. And basically the insurance company undertakes to indemnify or basically to compensate the insured on the happening of a specified event. And in that case now, the insured is required to pay some consideration which is known as what? A premium. So therefore, we can start by defining an insurance contract. So we can say this is what is a contract, is a contract or an agreement entered into by an insurance company, which in other terms is known as the insurer, and the insured, and the insured. So in this case, when we talk about the insured, so this is the policy holder, holder. So basically it's a contract which is entered into between two parties. The first party is called the insurer or the insurance company, and the insured. So, and generally what you have said is that in this particular contract here, the insurance company or the insurer will undertakes, or basically will make now or will enter into a commitment to indemnify or basically to compensate the insured on the happening of a specified event, So we can say in this contract, the insurer undertakes to indemnify the insured on the happening of a specified contingency. Basically, a contingency is an event which may or may not occur, like an accident. An accident is a contingency. An accident may or may not do what? Occur. To indemnify the insured on the happening of a specified contingency in return of a consideration, known as premium. So once the insurance company undertakes to indemnify the insured on the happening of that particular contingency, then in this case we are saying that the insured is required to make some periodical payment to the insurance company, which are known as what? The premiums. Now in this case we have two types of insurance contracts. We can talk of types of insurance contracts. So generally the insurance contracts are classified into two main categories. So we can say there are two main types of insurance contracts. And they include what? Number one, we have something called the life assurance, and the life assurance, and number 2, we have the general insurance. The general insurance. So when talk about the life assurance, this is basically a type of an insurance contract which guarantees the policy holder, or basically the insured, a certain amount of money upon attaining a certain age, or upon the death, or upon the death, basically, which may occur earlier. So mean that in this case, the policy holder will be given a policy, or will take a policy with an insurance company. He will be paying some premiums, and then the insurance company agree, or basically undertakes to pay that particular amount, a certain lump sum, a certain amount of money upon that person attaining a certain age, or upon the death of that person, whichever may occur earlier. So, and that's why we refer to this as an assurance. So the insurance company, by the end of the day, will have to pay a lump sum to that person, or even to his dependents, either upon that person attaining a certain age, or basically upon his death. But on the other hand, when we talk about the general insurance, this refers to any other insurance contract offered by the insurance company other than the life assurance. And therefore, these include insurance contracts such as the fire insurance, the marine insurance, what refer as the burglary insurance, and so on. All those are good examples of what refer as the general insurance. Now, what you have said is that IFRS 4 basically prescribes the manner, or prescribes the financial statements which are supposed to be prepared by companies which provide such contract, or which enter into such contract with the customer. So mean that at the end of the year, the insurance companies are required to prepare certain final accounts in accordance with what? With the IFRS 4. So therefore, you can look on the final accounts. Final accounts prepared by insurance companies, or in other terms, prepared by companies offering insurance contracts. So here we have around 3 final accounts. So we can say that they include, number 1, we have the revenue account. Revenue account. Number 2, we have general statement of profit or loss. General statement of profit or loss. And number 3, we have the statement of financial position. So these are the 3 final accounts which need to be prepared by insurance companies offering insurance contract to their customers, or basically to their clients. So let's start by looking on what is a revenue account. Revenue account. So a revenue account, this is a final account prepared by insurance companies to ascertain how different insurance businesses undertaken by such an insurance company are performing. Because an insurance company may be offering, offering various insurance policies, like what refer as the fire insurance, the marine insurance, the burglary insurance. So the revenue account, this one we are saying, is prepared to determine how each insurance business is doing is performing, not the performance of the entire insurance company, but the performance of individual insurance business. So therefore, you can say that it is prepared. It is prepared to ascertain the performance or the financial performance of each insurance business its insurance business. Insurance business. So how do we prepare this particular account here? So let's look on the format of the revenue account. The revenue account. So for the revenue, or basically this revenue account, first of all, it is prepared using a vertical format. We don't use the a T format. And remember, this should be the revenue account for a certain year. For the year which ended on a specific date, you must be given the date there. And also we have, basically we have a number of columns here, starting with the details column, and then columns for the various insurance businesses. So like maybe we assume in our case, this insurance company preparing this revenue account is involved in two insurance businesses, the fire insurance and the marine insurance. Two insurance businesses. So always what we start with here are incomes from these two insurance businesses. So the first main source of income from any insurance business are the premiums which will be received from who? Which will be received from the clients and so on. So the first thing we record here is the net premium. Remember, in this case, what you have said is that once you enter into an insurance contract with an insurance company, the insurance company will do what? Undertake to compensate you on the happening of a specified contingency, and then on your part, you have to pay some premium. So that premium you pay to the insurance company is actually the main source of income. So, but we determine net premium. We're going to look on how we determine this particular net premium, because the examiner will not have given you that. We're going to look on how we determine that, the net premium. And then to this, we add something called the unearned premium. The unearned premium, balance brought down, unearned premium, balance brought down. So what is unearned premium balance brought down? When talk about this unearned premium, it is important for you to note that once you enter into an insurance contract with an insurance company, the premium which you pay, in most of the cases that premium is for 1 year. So meaning that if, for example, you have a number of clients who have paid a premium to cover them for a certain period of time, and that period covered by those particular premium has not come to an end, then we say that that premium to the insurance company has not been earned, because that premium can only be earned if the period covered by that particular premium has come to an end. So therefore, what we do, we take the unearned premium at the start of the year, we add it to whatever you have there, and then to this we less the unearned premium at the end of the year. So this is a premium paid during the current year, but when the year is coming to an end, because the period covered has not expired, that premium has not been earned. You less it there. And then to this, we also add something called the commission on reinsurance. Commission on reinsurance ceded. Commission on reinsurance what? Ceded. So what is the commission on reinsurance ceded? Or first of all, what is a reinsurance ceded? Assuming we have an insurance company here. This is our insurance company A. And also we assume we have another insurance company here. Insurance company X. And then we also have another insurance company here. Insurance company Y. So basically, this particular insurance company here, that is insurance company A, which now we assume is the one preparing the revenue account, may be given some insurance business. By company X. So that insurance business which has been given to company A by insurance company X, we refer to that as reinsurance business accepted. Reinsurance business accepted. So therefore, this particular insurance company will have to pay some premium. Will have to pay some what? Premium. So therefore, first of all, we talk of the reinsurance accepted. The reinsurance accepted. Ordinarily, this happens whereby an insurance company feels that the risks which have been insured with it are too much, and therefore such an insurance company may decide to reinsure some of the risk with another insurance company. So for example, this company may feel that the risk which are insured with it by its customers are too much, but this company, for rate to reduce its risk, it decide to reinsure some of those particular risks with another insurance company. So once this company give an insurance business to insurance company A, to insurance company A, we refer to that as reinsurance business accepted. It is obvious that if I give you some business, if I'm an insurance company, give you some business, you must pay me a commission. You must give me a commission on the business which I've given you. So therefore, this particular insurance company here, because it has been given some business, it will have to pay some commission. It will have to pay some commission. So in this case, we talk of commission on reinsurance accepted. Reinsurance accepted. Now, this commission which has been paid by our insurance company here, this is an expense. This is an expense. But on the other hand, also this insurance company may feel that the risks which are insured with it are too much, and therefore it decide to reinsure some of those particular risks with another insurance company, say insurance company Y. So first of all, we say that those particular risks which have been insured with another or that insurance business given to this insurance company, we can refer to that as reinsurance business ceded. This company has felt that the risk insured with it are too much. It has ceded ground, and therefore it has decided to transfer some of the risk to another insurance company, say insurance company what? Y. So therefore, this company here will have to pay some premium to this one. So basically, we refer to that as the reinsurance premium paid. And because this insurance company has been given a business, it will have to pay our insurance company here a commission. That commission is known as a commission on reinsurance ceded. So this commission received by our insurance company A, which is known as a commission on reinsurance ceded, we are saying is an income. Is what? Is an income. And always this particular a commission on reinsurance ceded, this one is computed based on the reinsurance premium paid. Is always computed on reinsurance premium paid. That is very, very important. Always will be given a commission, or this commission is a percentage. To compute the actual amount of commission received, multiply that percentage with the reinsurance premium which were paid. And then what we do here, we get the total incomes. The total incomes for each insurance business. And then to this, we less expenses. So the first main expense for each insurance business are claims which have been paid. So the first expense is the claims, or the net claims paid. Remember, this is an expense. We list it here. The other expense is what I've explained here. That is commission on reinsurance accepted. Reinsurance accepted. We list that there. So the other item which we also deduct here is things like the management expenses. Management expenses relating to each insurance business. Relating to each insurance businesses. And then we also have any other expense. Any other what? Expense. And after deducting those particular expenses from the total incomes, then we get now the net profit from its insurance business. From its insurance what? Business. So basically, that is how we prepare that account, the revenue account. But basically, there are two items which you have to compute here. This one, and actually not two items, actually four items. We will note something as far as these four items are concerned. How do you determine those four items? Because those are items which the examiner will not give you, you have to do what? To compute. So let's start by looking on how we compute the net premium before we proceed and look on the other final account, the general statement of profit and loss. So can we first of all look on how we compute those items here, starting with the net premium. So these are some of the workings definitely you have to do, or these are some of the items you need to compute. One of it is the net premium. So the net premium, this one is computed by preparing an account called the premium account. Is prepared by preparing the premium account. Computed by preparing the premium account. Premium account, by preparing premium account. So how do we prepare this premium account? Premium account. So basically this premium account equally will be prepared for its insurance business, assuming our company is involved in two insurance business, fire and marine. So we have two columns on both the debit. Remember, these are ledger accounts, both the debit and the credit side. So fire and marine. So the first thing we start by recording here is the premiums which were not yet received at the start and also at the end of the year. Remember, an insurance company receives premiums from its customers, from its clients. So any premium not yet received from the customers, or even the agent, insurance agent, the stock, the brokers, is an asset. So that is the first thing you record here, the premium outstanding, or the premium not yet received at the start of the year, because this is an asset, and then the premiums not yet received at the end of the year, we record them there. The other item which we also record in our account here, we also record in this particular account here, are the reinsurance premiums received. Reinsurance premium received, and also now the other premiums. Premiums which were received either from the clients, either from the agents, either from the brokers, and so on. We record them on that side. And then on this side, what we record is the reinsurance premium paid. Reinsurance premium paid. Yes. And then from there, what we do, we balance this account. We balance this account. So the balancing figure, which should be on the debit side, which should be the debit side. This is the net premium. The net premium. And basically this one is what now we transfer to this particular account here, which is now the revenue account. So that's basically how we determine the net premium. Then from there we have this one, that is a commission. The other item number 2, commission on reinsurance ceded. Commission on reinsurance ceded. Reinsurance ceded, basically, which you have said is an income we have said that this is basically a commission which will be paid to an insurance company as a result of giving another insurance company some business. So therefore, we have said that this one, this is an income in revenue account, and it is computed based on reinsurance premium paid. That is very, very important. We compute it based on the reinsurance premium paid, because the examiner will just tell you the commission on reinsurance ceded is maybe 10% or 5%. To compute that amount of commission, you compute it, you take the percentage given times the reinsurance premium which were paid. So then we have the other item here, which is the net claims. The net claims, how do we determine net claims? Net claims. So net claims, first of all, is the amount of money which is claimed by the customers or by the client of the insurance company. Assuming in this case you have insured a certain subject matter, you have insured maybe your car is involved in an accident. So what you do, you raise a claim with the insurance company. The insurance company will do some assessment to see what caused the accident. If your claim is accepted, then what will happen is that the insurance company will have to pay you some claims, will have to compensate you. So this claim is actually one of the main expense by an insurance company. But equally, how do we determine these net claims? So this one is determined by preparing an account which is called the claims account. This is computed by preparing the claims account. By preparing the claims account. So let's see how this account is prepared. Claims account. Equally, we prepare this for each insurance business, assuming an insurance company is providing to insurance business fire and marine. This will be the credit side of our account, the debit side. So what you start by recording, or the first item you record in this account, are the claims which were outstanding. When talk about the claims outstanding, we are talking of the claims not yet paid by an insurance company to its customer. So automatically that is a liability, and that is recorded as an opening balance in this account of the credit side. And then we also record the what? The claims which were outstanding at the end of the year. Then from there, what we also record in this particular account are the claims which were paid during the current year. Claims paid, we debit that in this account, and also any expense relating to the claims. Any expense relating to the claims. And then we balance our account. So the balancing figure, which now will be on the credit side, will be the net claims. And we are saying that this is a balancing figure, and that is now what we transfer to our revenue account. So then let's look on how we determine the last item here, and that is the commission on insurance accepted. This should be item number 4. Commission on reinsurance accepted. Reinsurance accepted, which first of all we said is an expense. So this is an expense. And it is computed based on reinsurance premium received. Very important, computed based on reinsurance premium received. Basically, this is a commission which you have said is paid by an insurance company as a result of receiving an insurance business from another insurance company. That's why we are saying, once, for example, I give you an insurance business, I have to pay you what? Some premiums, and basically in return you pay me what? You pay me a commission. So the commission you pay me to you is basically what? An expense. So that's how we compute the what? The commission only insurance premium, the commission only insurance accepted. Reinsurance what? Accepted. Yes. So basically those are some of the items you must be in a position to do what? To compute. So that's basically how we prepare the revenue account. So then from there we have the general statement of profit or loss. General statement of profit or loss, or basically the general income what? Statement. So this one is basically prepared now to determine the profit or loss from the insurance company, not from a specific insurance business, the profit or loss of an insurance company in a certain financial year. So we can say that this is prepared to ascertain the profit or loss of the insurance company, not insurance business, but insurance what? Company in a certain financial year. In a certain financial year. So how do we prepare this particular general statement of profit or loss? Let's look on the format. So format of the general statement of profit or loss which is for the year ended on a specific date. You must be given the date there. So equally, when preparing this, we prepare this using a vertical format, and we start with the incomes. So the first income we start with here is the net profit from various insurance businesses, e.g. fire, e.g. marine. And this particular net profit is what now we got from our revenue account. So after preparing the revenue account, you get now the profit from each insurance business. You bring it here as the first source of income, and then to that you add other incomes by that insurance company, e.g. investment income, etc. So add all those incomes and then get the total incomes, and then you proceed, you less now the expenses. So, and equally the expenses which we less here are the general expenses. So when talk about the general expenses, we are talking of those particular expenses which are incurred by the insurance company, not as a result of undertaking a certain insurance business. They are general expenses, like maybe the depreciation of assets, the salaries and the wages to the employees, and so on. So the expenses which we consider here include depreciation on property, plant and equipment, or depreciation on PPE, other expenses like wages, salaries and wages, the general administrative expenses, etc. We get the total expenses, we take that now to the last column, we deduct it from the total incomes, and because this is a company, whatever we get here is a profit before tax. Profit before tax, and then to this we less the income tax expense. We less income tax expense. Income tax expense. And then we get the profit for the year. The profit for what? For the year. So generally, that's how the general statement of profit or loss is presented or is prepared by what we refer as the insurance what? Companies, insurance companies. And then from there, finally, we have C, the statement of financial position. A statement of financial position, SOFP, previously known as balance sheet. And this one is prepared basically to ascertain the financial position of an insurance company at the end of the year. And also we know that this one is prepared based on the accounting equation. So we can say this is prepared to ascertain financial position of an insurance company at the end of the year. Now, in terms of how we prepare the statement of financial position of an insurance company, or the format used in terms of preparing this is just the same with the format used in by other entities, including companies, or including private companies, public companies, and so on, in preparing the statement of financial position. So therefore, you're not going to look on the format here, because the format is just what you covered in the lower level, financial reporting, in the intermediate level, financial accounting in the foundation level. But when looking on a question, we're going to see on how this statement of financial position is presented. So for now, I want us to stop at that particular point. And basically what we have been able to do as far as that topic is concerned, we have defined what is insurance contract. We have looked on the various types of insurance contract, the final accounts which need to be prepared by the insurance companies, or basically companies providing insurance contract, which you have said are 3 revenue account, general statement of profit or loss, and also the statement of financial position. So therefore, what I want us to do, once we come we meet in the next session, we're going to look on an illustration regarding how to prepare financial statements by insurance companies. So for now is a bye. See you in the next session.